Dominic, over to you, and we'll chime in from time to time.
Sure. So thanks for having us. We've been talking about doing this for some time. Iconic plays, at least we like to think we play, a large role in the institutionalization of this market. We are based in Frankfurt, Germany. I am based here in the States, in New York. And, in Germany, I think our brand is synonymous with the institutionalization of crypto. And we're working on the same thing here in the States. And so what we wanted to do is actually build out a panel that really speaks to everything that is part of the institutional ecosystem. So we have large brands, which we'll introduce in a second, which represent well-known players in the asset management market that I think everyone on this call will recognize. And we also have crypto natives that everyone may not recognize, but these people are very much part of the crypto ecosystem. And everything that underlies what we do is to sort of help people understand what institutional crypto is, how one can get involved, why now. All of these are questions I think we can start to answer on this panel today. I did notice that everyone is on, so I'm just going to start introducing them. So the panel includes Josh Deems from Fidelity Digital, Sven Werner from State Street, Wilfred Day from Enigma Securities, which is a digital assets focused broker-dealer here. That's part of a much larger group that actually has offices in Paris and London as well. And then again, me from Iconic. We lost one person. Unfortunately, we had one person fall ill early this morning at 3:45 a.m. We found out that Damien from Napoleon Asset Management, who's based in Paris, would not be able to join us. He's under the weather. The perspective he would bring is that of actively managed crypto strategies, as they are a digital assets focused hedge fund. But I feel that Wilfred and I could probably provide some insight into, and maybe everyone on this panel can provide some of the insights that Damien was going to provide on this panel today. And with that, I think the best thing is to just introduce everyone individually and let them have an opportunity to talk about who they are, what they're doing, what their firm's doing in this space. With that, let's start with Sven. Sven, can you tell us about what your role is at State Street, what State Street's doing in crypto? Give us a sense of what's going on there.
Yeah, pleasure. And hello, everyone.
And if you want to share any slides, I can stop sharing and allow you to do that. It's your call.
Yeah, I won't have any slides, but I don't know what my other fellow panelists. So my name is Sven. I work for State Street. We are, as you know, an asset servicing institution, an asset manager. So helping organizations to manage long-term investments, risk management, and also their long-term liabilities. So my responsibility is really, in the classical sense, a product manager. I started my career in various security services, custody, collateral management, what have you, and always from the perspective of what are the long-term industry changes that require the firm to take a stance, where usually what we like to do, and we do this a lot, we go out to clients, talk to them, ask them what you want, and then we try to build it. When it comes to some of these disruptive technologies, blockchain and digital assets being main one, but we have colleagues that are also looking at other things like AI and what have you. We really need to, on the one hand side, obviously listen to the customer voice, but you also need to imagine what the future could look like when you can't really ask anyone. And so you have to synthesize and work with the different scenarios. So that's really what I'm trying to do. Looking at blockchain, digital assets, how it applies to custody, fund accounting, asset servicing, but also cash, CBDC being one of the examples, and how the organization needs to change, what kind of services and products we need to develop to be ready for the future. And the prime example for that digital asset strategy is obviously at the moment Bitcoin and other crypto assets. And so we're looking what the options are in that space.
Thank you. And we look forward to hearing more from him as we go through the panel. Josh, tell us about what you're working on at Fidelity and what Fidelity is doing in crypto.
Yeah, thanks, Dominic. Really glad to be here. And so I'm Josh Deems with Fidelity Digital Asset. Fidelity Digital Asset is a wholly owned subsidiary of Fidelity Investments, the asset management firm, sort of the household brand name in terms of retirement accounts, brokerage support, custody, etc., both in the U.S. and abroad. We started looking at crypto in the 2012-2013 timeframe, and kind of using the Fidelity Center for Applied Technology, started really getting our hands dirty in the. So we saw Europe had just moved from T3 to T2 settlement, and the question was brought up internally: could we handle instantaneous settlement within our infrastructure if the world were to move in that direction? And the closest parallel we had to experimenting with that was Bitcoin, which settles on a 10-minute sort of scheduled time cycle. And so we started getting like I mentioned, getting our hands dirty with the technology. We started mining Bitcoin in 2015. We allowed, this is one of my favorites, associates to purchase things in the cafeteria with Bitcoin in the 2015 timeframe. So you might have purchased a sandwich for a few bucks in Bitcoin back in the day. That may be a really expensive sandwich today. And then we started also accepting Bitcoin through Fidelity Charitable, as a donor through the donor advisor Fidelity operates. It's through this whole process, through the experimentation phase, we got a lot of inquiries from institutions. We had needs to hold our own Bitcoin as our mining ended up being relatively fruitful. And so we actually went ahead and launched a business unit called Fidelity Digital Asset, formally in October of 2018, but something we've been working on for some time to help institutions who want to interact with Bitcoin, digital asset, whether or not they, regardless of their investment thesis, if they see this as digital gold, as the new payments platform, as a speculative venture investment, etc., build the infrastructure for them to handle that. So I help Fidelity, bring these efforts to market, and been working here for about 3 years. And today, what we offer is the ability for institutions to hold Bitcoin, to trade Bitcoin, and we also act as a agent for managing private party collateral. So more to come in terms of additional products and services. We're kind of going down the stack, becoming an end-to-end broker in the platform.
And Wilfred, give us a sense of what Enigma's doing and what you do there.
Thank you. Glad to be here. My name is Wilfred Day. I'm a CEO for Enigma Securities. So Enigma Securities is a UK-based broker dealer in crypto as well as the traditional asset class. We formed roughly about 2017 when we had a lot of reverse inquiries from traditional asset managers, clientele looking for ways to getting crypto exposure. So we back then, as of today, we belong to a larger broker dealer. It's called a Macquarie Group, Macquarie Capital. Headquarters in London. We have offices in Geneva, Tel Aviv, Paris, and also in New York. So over the last 3 years, we have built our own technology platform. It's called Enigma X, which is a order management, execution management system, and has a little bit of settlement capabilities as well inside of it. So over the last, let's call that 9 months or so, we traded in billions in crypto asset. So our technology arm is based in Tel Aviv. So we serve, we provide this technology to asset managers and payment service providers and so on and so forth. And on the service layer, we're agency broker. We also have a little bit of borrow land business globally, and the distribution as well. We offer our clients a research stack. So we produce weekly research as well as sort of a technical quantitative research offering, focusing on the crypto derivatives market. So overall, we're more of a crossover, if you will, from a product perspective, especially in crypto related ETF, exchange traded funds or exchange traded products. as well as sort of crypto, primitive products like in BTC, USD, and so on and so forth. We also offer EFX trading as well from one of our prime brokers. So that's a little bit about Ingma Securities. So, I obviously came from a pretty much traditional markets, and I came from a Lehman Brothers in the capital market side, and primarily in the structured finance and the derivatives market. And then, prior to Ingma, I was with a couple of the cryptocurrency firms, Noble, which actually was the first crypto bank in the US. So I was a portfolio manager there. And OKEX is one of the largest, crypto exchange in the market. So I've been on both, bank side and as well as the liquidity provider side of the equation in cryptocurrency space.
Yeah, and Wilfred and I have known each other 15 years. We used to work at a hedge fund together. We sat on the credit desk together at a structured credit trading desk 15 years ago. So it's very interesting to see the number of people from back then who've migrated to this space over the last couple of years. With that, let's kick this off. Let's start at the basics. Let's talk through or touch on the investment thesis for crypto. I know a few of you produce research, including us. What's the reason for people to come here and put their money to work? Who wants to be first? Josh?
Yeah, I'll start it off. So I think there's a couple of different investment fees around digital assets in general. So the way I contextualize it is we have sort of the store of value, thesis that Bitcoin has helped accelerate, or Bitcoin's been the main accelerant of. And the investment thesis around Bitcoin is really different than the investment thesis around other types of crypto assets. The investment thesis around Bitcoin really comes down to the belief in a hard money system, the belief in a non-sovereign decentralized monetary system. The rules are codified. The sources of the source code is open and available to the public, and so it has these known tangible properties of being a decentralized internet native currency that has limited value. Right? That has limited supply over time. So the story with Bitcoin is, as time goes on, if you compile sort of the concept of Metcalfe's law, the network around Bitcoin growing, along with the scarcity argument of the asset actually, the creation of the asset becoming less and less over time, then you have sort of this sound money, hard money thesis that a lot of investors are piling in around. And so those types of investors in 2017, were a bit more retail in nature. This time around, as I'm sure folks have seen, CNBC, Wall Street Journal, Bloomberg coverage of the asset class is really around institutions that are looking at the alternative section of their portfolio management strategy and saying, okay, we have a 10% allocation to alternatives or 10% allocation to commodities. Maybe we'll take a percentage of that and allocate it to Bitcoin. If you're someone like Michael Saylor at MicroStrategy, you've taken your entire balance sheet and allocated it to Bitcoin. And so, we've kind of seen the gamut of the appetite of firms to, move out of cash. A lot of the moves into Bitcoin are either coming out of cash or coming out of fixed income. That's kind of the one thesis around digital assets. So Bitcoin, longest, standing, it has fixed supply. There's a very strong community behind it. There's a strong adoption curve. And then there's the other crypto assets. So not, I think of other crypto assets, folks have probably heard of Ethereum, EOS, these buzzwords, decentralized finance, et cetera. Other crypto assets are helping power the sharing of information and the sharing of information that has value. So whereas Bitcoin is really like hard money gold thesis, something like Ethereum is helping power programmable money, where based on X result, Y happens. So that could potentially upend the way that we share information in terms of banking, the way central counterparty risk is mitigated. The types of the types of investments that are tokenized and can live digitally native as opposed to remaining completely illiquid. The fundamental principles of both rely on the same technology, but the monetary governance, the use cases are very different. And so Bitcoin has been this sort of proven 10-year-old store of value, very young, 10 years old in terms of store of value is very young, but it's been open source, decentralized for since its existence. Other protocols are attempting to use different principles in terms of creating things on the internet that can be transferred without needing to have a central intermediary. So the value thesis around Ethereum and other types of crypto assets is this decentralization, this more of this venture investment in assets that could potentially displace the traditional banking system that we see today.
What are the things that we see? And this is again what we hear from investors who've been involved for, say, the last 2 or 3 years. They like the prospect of having a VC-like return from a liquid or maybe semi-liquid asset. There are people who basically invested in these, if you think of them as new pieces of technology, these new technologies, who've been able to have liquidity events, in a year or less, and really you can have them daily. I think that has drawn a lot of people in as well, is this desire to get the kind of 10x, 100x returns that VCs are often targeting, or at least we hear them targeting in their decks, but actually able to get that not in a 10-year lockup period, which you would traditionally see with a VC fund, but in much shorter periods of time. So I think that also is something that's driven institutional money into this space. Wilfred, what are you hearing from clients as to why this space and why now?
Yeah, so yeah, thank you for that. Sort of comments. What I see in the market is there are a lot of institutional clients coming. Obviously Ethereum and other altcoins, I would say, quote unquote, exist in the marketplace. And Bitcoin continue to be the asset class or asset to go to. And this is one of the reasons because there are a lot of institutional quality infrastructure around it. Like Fidelity has a great product in custody solution, and they're and that's a really a proven sort of a service already in the ecosystem. And obviously from technology perspective, if you think about Bitcoin as a operating system, I compare that to Microsoft DOS. Microsoft OS has a number of iterations over the many years. Bitcoin as an operating system is relatively mature. From a software perspective, is a very fairly mature product already compared to other asset class, the altcoins. We have a lot of clients who are interested in not only sort of a exchange type of trading venues, but also venues through, say, CME derivatives market. So there's whole vertical, I would say, vertical expansion of a number of products associated with Bitcoin already. So folks can generate the interest rate on Bitcoin through Borrow Land Desk. They can do that through the options market. You can do that through the CME basis market or the futures market. So there are a number of ways that institutions can participate in the Bitcoin itself. So there are a number of ways to expose from traditional asset managers into the crypto space.
So it sounds like you're saying part of the reason why we've had, for example, this wave of institutional money come in over the last 12 months, maybe even longer, is because the pipes are better? Is that what you're saying?
Yeah, so I think the products are much better. One of the things that you observe in the market is probably the Grayscale product. It has grown significantly. Now, ETP or exchange traded products as a complex is well over 30 billion as a collective sort of, I guess, a complex. And that helps, I would say, facilitate some traditional folks in getting into crypto exposure. And that's sort of an easier way for a lot of folks. rather than go buy BTC physical, find a custody solution, so on and so forth. So they're doing this indirectly through the ETP products.
So you raise an interesting point with these exchange traded products. One, like everyone on this call has heard of exchange traded products, right? Whether you invest in them or not, there's something that are on your radar. They may not be as familiar with crypto-backed exchange traded products. So what has it taken? Let's talk about what it's taken to get to the point where we can talk about crypto exchange traded products. What has had to happen such that we could get institutional money into crypto exchange traded products? Sven?
Yeah, I mean, that's the ETP is an interesting example. So if you look at Europe, the market size really grow like 10 times within 2 years. So we're now at 3 billion or so AUM. Obviously, it's much smaller still than the US, but the growth rate is quite phenomenal. However, if you dissect this, we shouldn't underestimate this. A big driver of that increase is the phenomenal growth of the Bitcoin price itself. So in a way, Bitcoin grew 10 times, so did a lot of the products that were invested already at that time. Where are we now? I think for me, there are two ways. So obviously on the one hand side, and that's a strong trend, the search for alpha and these kind of products in a low interest environment are potentially interesting for organizations and investors. But as a custodian, in a way, I don't really take a view on, is this a good idea or bad idea to invest in a certain asset. What I care about is, can you service those assets and therefore ensure that there's sufficient investor protection in line with the requirements? And I think a number of things happened there that regulation moved along. We have certain markets where Bitcoin is now considered a financial instrument, like in Germany, for instance. In that sense, Germany, for instance, being relatively forward thinking. You also had the situation that we had a few instances in Asia as well in the US where there were issuers of traditional securities, which then decided in their wisdom to issue dividends in a crypto format. So you created therefore a situation that an investor which wasn't necessarily thinking about this suddenly were exposed to that challenge, how to deal with this. Plus, as I mentioned earlier, that we are now seeing in various locations the necessary regulatory framework being drafted. You now make it possible for regulated asset managers like IVES, etc., and in Europe to invest in these kind of products. And I think the ETNs really help from a convenience perspective, because from a pure, as an investor, for purchasing these securities, settling that, the whole service requirements can be done through the normal channel. So it's in a way that's a nice way for investors to get to tip in to that market, to see how it looks like, without necessarily having to deal with the underlying complexity of the blockchain technology itself.
So I'm hearing, one, the way the instruments are identified as financial instruments, at least in some places, has changed such that it's acceptable to own them. There have been improvements in the quality, in the amount of custody solutions available globally, which means that you have these regulated funds that can now touch this asset, and they can work with sort of established players in the market and custody their assets with these well-known players. And it seems regulators are catching up to the technology. So this, obviously the US is a big market. How do we feel about how the direction of regulation in this market and the adoption of crypto in this market? And can this market drive the next wave of growth in crypto?
Yeah.
For any of you, yeah.
Yeah, so Dominic, I think we've had a lot of there's been a lot of news from the regulators in the U.S. over the course of the last, call it, year and a half. The primary news in the U.S. In this kind of existing cycle really dates back to the hearings in Washington last year around the Libra Foundation, which was the and still exists in a bit of a different form, but there was an idea by Facebook to create its own form of currency and have it transferable through all Facebook applications, Instagram applications, etc. And so that received a lot of scrutiny in Washington. Obviously, you're combining the issues of big tech and the loss of control of a financial network, and clearly, you're going to be met with a lot of headwind there. So there's been some enforcement, or not so much enforcement, but there's been movement on how do we wrap our heads around the concept of a stablecoin in the U.S. Stablecoin being a dollar denominated or a fiat currency denominated asset, and so earlier this year, late last year, the Office of the Comptroller of the Currency came out and basically stated that banks, regulated federally chartered banks, can hold cryptocurrency on behalf of their clients. That was watershed, because it allows banks to then go out and create their own their own version of a stable coin if they'd like, but it also allows them to hold crypto assets on behalf of their own brand customers. So, if you look at National Bank, before the regulation was a little bit clear, now, they know for a fact that they can either design their own custody solution or use sub-custodial model like in the traditional market to have access to something like this for clients. That was really the watershed event on holding the fundamental underlying asset.
Can I interrupt you for 1 second? It should also be said that the Office of the Control of the Currency, the person who made that decision, who drove that decision, used to work at a crypto platform. And so one of the things I think you're starting to see is part of why I think regulation here in the States will catch up to the technologies, because you see people going back and forth. You see people going from industry to regulator and from regulator to industry. And so the understanding of the products is changing for the better.
For sure. The other, Dominic, the other interesting kind of boomerang, I guess, to that is Biden's pick for head of the SEC, Gary Gensler, who former chairman of the CFTC, but he's literally joining the SEC, which has been sort of the preeminent regulator, in terms of disapproving new, products and services around crypto in the U.S. He's being pulled out of a post at MIT where he was teaching a class about Bitcoin, cryptocurrency, and blockchain. So it's going to be really interesting to see kind of what happens over the next couple of months at the SEC. There's traditionally been more dissenters than approvers at the SEC in terms of allowing like a Bitcoin ETF, for instance, in the U.S. So something we're definitely keeping our eyes on.
Certainly, and again, for the context of the crowd, our previous SEC chair was the sworn enemy of cryptocurrency. He made there was no ambiguity about that. And now our expected chair is a person who taught a class on it at MIT. Like let that fold over you a little bit on what could happen here. The antagonism between the government and participants in our market could be changing completely 180 degrees after his confirmation. So, it raises the prospect for more acceptance here, which potentially drives greater demand for crypto. Because this is obviously a huge market for all financial products. And I think if crypto were more greatly accepted here, we'd see just tremendous demand for digital assets. So
if I may just add on one comment on this. So I agree with that sentiment. However, if you want to continue, so it's not a monolithic institution investor. So in states, do you think about obviously organizations like insurances and sovereign wealth funds on the one hand side and alternative funds on the other side. So and I agree with the interest to create regulatory frameworks that allows investments in crypto assets to become more mainstream, and we have that both in Europe as well as in the US. However, because Josh mentioned the holy grail of crypto, the Bitcoin ETF, and whether or not a future regulator would approve it. If you look at these kind of products, there are open questions that haven't been resolved yet. And that has to do with how fund regulation, particularly for funds that hold retail money, has evolved over the years. If you think about the 40 Act fund in the US or UCITS or other mutual fund in Europe, where the requirements and have been defined how a custodian like State Street or any other has to protect those assets, those requirements don't always work really well with crypto. So just give you one example. As a custodian under European law, I have to ensure that I have determined the right moment when ownership has been received, so I can inform the client, I have verified you're now the owner of a certain asset. If you take crypto with its mining process, multiple block updates, it's very hard to pinpoint that exact moment. Are you now the owner, or do I have to wait for another block to be mined? So the regulators have to really now rethink a little bit some of the rules they have established. And from a principle perspective, they are right. Nobody is doubting them. But how you would comply with them in future, given that the underlying technologies are different, that hasn't been really worked out yet. And so I think it's more work needs to happen before some of these regulated products that are open for retail investors to hold, pensions, etc., before that can really happen. I'm not saying it's not going to happen, but the devil really is in the detail here.
Yes, and my guess is that these are not issues that'll be worked out in the first quarter of this year. It's going to take some time to work through these.
Absolutely, absolutely. But it's an exciting journey, and I think panels like this just show, this will happen over time. I'm just saying, if you look at the institution side, alternative funds, investing in investing in exchange-traded products that are not ETFs, then we're kind of there already. That sort of we've worked that out. If you push the envelope a bit further into the ETF space, you open up new challenges. That's maybe sort of the work, what's on the work slate for this year then for all of us.
So can you give us a sense of, we've started to see the adoption certainly of exchange traded product in Europe, right? So in Germany, we have a number of exchange traded products that are crypto backed. What do you see as the reason why regulators there were willing to give these products the green light, whereas here we basically said it's a no-go, and as you said, the rule set may not even appropriately apply. So what is the difference between these two sets? Because we think of Germany as a tier 1 regulator, right? This is not a place where, without rules that just lets anything happen. So why crypto-backed exchange traded products in Germany proliferating, while here in the States they're not green lit as so far?
Yeah, so I don't think it's not necessarily a judgment on the assets. I think many regulators across the globe have jumped over that hurdle and said, okay, we see particular millennials and younger people, they have a keen interest in these kind of assets. So let's find ways of doing this. These exchange traded products in Europe are all not funds. So they are typically a form of a debt instrument with that tracks then the price of Bitcoin or any other crypto assets through a collateral structure. So these are, if you want, speculative products that can be traded by retail investors. And the way the framework works really is then at the point of sales, or if banks were to advise their underlying clients, how to manage their money, they would look at the risk appetite of these clients and then make a judgment at that point whether that product, you know, fits their risk appetite. So the difference really comes to when, you know, oversimplifying a little bit, but the idea of an ETF or mutual fund structures, it's highly regulated, it's highly safe, and things like, I mean, this was a particular issue in the US, but we will have the same issue in Europe when ETF structures were to be allowed for European markets, how to ensure that the price by which you value your crypto portfolio is adequate. On the regulated side today, when you have a Daimler shares that's listed on the Frankfurt Stock Exchange, that's the home market, that's where a lot of the liquidity is. So you can say, if I look at the price of the home exchange, I can be somewhat certain that this is a reliable price, because as a custodian, for instance, I have an obligation, if an order comes in to settle something, that the price at which the fund invests in asset is a market appropriate price. If I now have to do that work for Bitcoin, I mean, maybe Josh has a few of this, but how can I say, given the high volatility, given that it's an emerging asset class, how can I say that the price at this exchange is an appropriate one as another one? And so therefore, what regulator is saying is, I have no problem with crypto, I have no problem with investments, but the specific investment vehicle of a regulated fund, particular an ETF, we have still some open questions, but things may change. I'm not saying they are insurmountable, but I think that's the difference if you want the quality brand attached with particular investment vehicles.
Wilfred, I know that the exchange traded product space is near and dear to your heart. What are you seeing along the lines of adoption for those products or through those products?
Yeah, so typically the clients coming to us for crypto ETPs are really fall into one of the three camps. One, first bucket is more of crypto native folks who owns BTC or Ethereum. That they want to generate a little bit of yield on their portfolio, because end of the day, the BTC is not, or Bitcoin or Ethereum, they're not yielding assets, interest bearing assets. So putting into ETP product and being able to capture a little bit of premium in secondary market allows them to capture additional alpha, additional yield, if you will. Second bucket of clients are really who are more traditional folks who wants to have a convenient, folks here I mentioned, an easy way to get into crypto exposure. So they're more of a focusing on a beta exposure in the asset class itself. So primarily focused on BTC, a little bit of Ethereum. And then a certain bucket of clients are really arbitragers or hedge fund managers who wants to play in sort of, I call this a market neutral space, exploring the differences or sort of market efficiencies in the ETN space. So that's really the three main buckets of clients we interact with on a regular basis. And going back a little bit on the sort of maturation of the ETP products in general, in my view, the sort of the key drivers really folks who are calculation agents underneath the index. So we have a Mavis, we have a few other folks out there, Bitwise, their index, Crypto Compare. All those guys are coming in with their own structure, own regulated way, compliant way to calculate the underlying index, allows better calculation of the NAV, for instance, for the associated ETN products. And obviously there's a growing interest in market making in the area. So traditional market makers like Gensler of the world, flow traders in UK, they're active market makers in the space. This is just traded as one of the equity names, effectively. So we see more fulsome development of the market structure in general. And that's quite, I guess, pleasing from where I stand, right? So, so that's my 2 cents there.
So, and maybe we should have started with this, to talk about sort of the structure of this market. If we went back a year, this market was what, roughly 80% retail, 20% institutional, maybe even less institutional. Is that more or less right?
I'd say like a year and a half, Dominic. I mean, basically coming out of the 2017, 2018 timeframe, you had lots of retail individuals opening up Coinbase accounts, buying, retail size purchases. It's hard to audit because that's all kind of maintained within someone like Coinbase's environment. But I think, the fun fact that gets spun out a lot is Coinbase opened more accounts during the 2017-2018 run up in the price of crypto assets than I think Charles Schwab has. So it's, something pretty substantial. But yeah, completely retail driven phenomenon. I think up until about a year and a half ago, we started seeing the tide change a little bit. And I don't know, Dominic, that was the rest of your question, but I'm more than happy to kind of continue on and answer that.
Yeah, just so the next step is then, okay, so let's say it was roughly 80-20 and it could be a little off, but where do we see it a year from now? What do we think the institutional retail split will be, or retail institutional split will be a year from now?
Yeah. So I think interestingly, like 8 or 9% of all issued Bitcoin are now held in corporate treasury. So if you're going down the math of how much of Bitcoin is held institutional versus retail right now, yeah, I'd say it's probably higher than 20% in institutional. Maybe it's 40%, maybe it's 50%, but who knows? It also comes down to how you define institutional retail. I can kind of anecdotally tell you though, in terms of our business, we have the benefit of kind of being plugged in on the back end to other parts of Fidelity, and the early drivers of this were what I'd call the more retail of institutions. It was single and multifamily offices, firms that didn't have to make an investment policy change in order to actually buy Bitcoin, and they could say, "Hey, I'm a tech founder, and I had a liquidity event, and I now have $100 million, and I'd like to allocate 10 million of that to Bitcoin." That was a kind of a common storyline that we saw for a couple of years. In the last year, it's really changed. It's certainly, it's a new breed. There's global macro hedge funds, kind of really led by Paul Tudor Jones in April of last year, coming out saying that he allocated 1 to 2% of Twitter capital in crypto, in Bitcoin specifically. And then that starts to de-risk the investment from a career perspective at some of these larger institutions that don't have the kind of the ability to say, hey, put 10% of my assets. So we've seen that really change. Kind of global macro hedge funds follow the trend behind family offices. And then we've seen an uptick on our side in terms of true institutions, endowments, pension plans, for registered investment advisors that have thousands of different clients that want this in their portfolio models, private banks. Like we've seen this really kind of tip the scale in the last couple of weeks or months, even towards this massive on-ramp of institutional demand. And you can also check you can use the Grayscale Bitcoin investment trust that we've been talking about as sort of a proxy for institutional demand as well. A lot of hedge funds are subscribing directly into that product, and supply of that product is outpacing the new supply of mined Bitcoin. So we're at a point now where so much of this is being eaten up by institutions, whereas before institutions were maybe dabbling in it a little bit. Now they're one of the primary drivers of market demand. You can see that through CME futures open as well. $2 billion in trading volume, which is small compared to other asset classes, but as a percentage of the overall amount of Bitcoin volume traded in a day, it's if not equal to. So it's definitely been.
And it didn't exist, what, a year ago or a year and a half ago?
It didn't exist. 2017,
yeah. So we have a question. How difficult is it for an institution to hold Bitcoin directly? Is that why shares like MicroStrategy exist, as they create an avenue to invest? I have a lot of feelings about this. So, but I'll start with you guys. So from your perspectives, how easy is it, or how difficult is it for an institutional to hold Bitcoin now?
Maybe if I give a start, right? So I don't know about easy or difficult, but from our perspective as a custodian that would then hold assets on behalf of clients, there are a number of questions. So one is around, if you want, uncertainty on the regulatory side. So, I mean, people, everyone knows about this issue around you have to keep your private keys private, but certain regulators, and this comes from this idea of, if you want, traditional custody thinking, I have to be able as a custodian to show I control the assets. And so regulators wouldn't only ask us to keep a private key safe, but they would also, FINRA in the US came up with this idea, they would also want to show that nobody else has that key. And that's in a way impossible because, you know, depending on your key generation policy, I may have a certain algo, but how, you know, there's at least a remote possibility that somebody would choose the same random number. So therefore, at the moment, it's, if you want, the practical aspects are somewhat understood, and there are now a number of models in terms of how you structure your data center to deal with this. But how you embed that service in a regulated activity, I think there are still some concerns. So in that sense, I would say, yes, it's still a challenge that we have a number of crypto custodians, but you do see differences in how well they understand to mold, if you want, their services and activities into the regulatory framework so that you can demonstrate to regulators you're on top of things.
Yeah, so I read this question differently. I was about to say the opposite. It's pretty easy because I was thinking in terms of functional. It's functionally quite easy to buy Bitcoin as an institution and custody it with a well-known big brand, if that's what you want to do. You could also, there are also some other options for custody as well. So functionally, it's fairly easy, but to Sven's point, it's less about the technology now and more about how one complies with regulation, which varies from market to market. So for that question, for the person who asked that question, Daniel, or I'm sorry, Duncan, it's functionally quite easy, but I think it can be difficult to comply with regulation depending on where you are. And as to the whole MicroStrategy angle, sure. I think the answer is yeah, that exists to make it easy for people to invest in crypto. So something like that doesn't really float my boat, but obviously there's demand for it, and there will be copycats. I mean, I'm familiar with some that are also pursuing similar strategies where they go out and issue a bond and use that to purchase crypto, and basically the value of the company is this crypto treasury that they purchased through some fundraise, which could either be through convert or some other kind of debt instrument. I do think you'll see more of those. Go ahead, Josh.
I was just going to say, I think the MicroStrategy example, I mean, Square has exposure to Bitcoin. Silvergate is the bank that it's publicly traded equity that all crypto platforms use because they have instant, cash settlement network built. There are like strategic ways to think about not direct exposure to Bitcoin. I think MicroStrategy is interesting because I don't think it was necessarily their intention to create an instrument that fully backed or mostly backed by Bitcoin plus, the return profile of a about 2000 business analytics company. So that one's a bit interesting. I think the thing to note here is, like, if you are gaining exposure to Bitcoin through alternative methods as opposed to owning the underlying Bitcoin itself, there's always going to be a trade-off. The trade-off is MicroStrategy is available in your brokerage account, and Bitcoin probably isn't. But then you're obviously you're buying something that could potentially be tethered to Bitcoin. But if MicroStrategy tomorrow decides they're going to change their treasury management strategy, then you no longer have one-to-one, or not one-to-one, but you no longer have that same exposure. That's kind of the reason we started our business line is so folks like true institutions who want to hold Bitcoin because of the properties Bitcoin affords you, and in terms of owning the actual underlying asset. It's really what we did in terms of starting. So there's, I think there's proxies available. I think there's other ways to get at least the correlation to Bitcoin in terms of the performance of the equities market. But Bitcoin sometimes has up days when equities market is down and vice versa. And MicroStrategy and others are going to be susceptible to that sort of I don't want to call it protection, but the uncorrelation that.
So we've got another question. I've been spending a lot of time trying to understand Tether. Do the panelists worry about the possibility of issues arising if Tether is found not to be backed one-to-one? What is your concern about this going forward? Well, Wilfred, you have some specific knowledge around this. How do you feel about Tether? Are you concerned? Do you transact in Tether? Do you worry about your clients transacting in Tether?
Yeah, I think if you there are a lot of ongoing legal matters or regulatory matters around the Tether for last let's call that four years. However, Tether as a sort of a utility token or stable coin, it's grown significantly, right? So in 2017, it was roughly about 4 billion. Now it's double that. So we do not interface with unregulated markets. So we only work with guys we understand, go through our KYC and MNL. We do not trade significant amount of Tether ourselves. However, we do trades on, for instance, USDC, which is a somewhat regulated stablecoin in US. I do think that Tether could potentially be a systematic risk in the crypto ecosystem, but I do not have any specific knowledge about being a one-to-one backed an asset in Tether. I can't really address any specifics on that. Yeah.
Does anyone know how much Tether actually is touched by institutions as opposed to retail? I think it's a substantial retail. There's a substantial retail component, correct?
Yeah. So from market structure perspective, Tether is typically used in unregulated markets, exchanges. The guys like Binance, Huobi, a few other unregulated markets. There's also Tether derivatives market out there, BitMEX, for instance. That's under the investigation of DOJ at the moment, for instance. So typically it's the unregulated market outside of US.
Yeah. So I think what you'll find is to the extent that institutions have been trading it, I think you'll find fewer and fewer institutions trading it. My guess is that it will still have a substantial retail component until something happens, at which point you might find individual investors get burned. I am not saying that they will be burned because I don't know their balance sheet. Like, I've read the stories. I don't know if they have the money.
No one knows their balance sheet, Dominic. That's the problem.
Yeah, I don't know what they own or don't own. If for the background of people here who don't know Tether, the idea is that it's a cryptocurrency that should be backed by cash one-to-one, such that you're trading a digital asset that basically has the same value as fiat that sits in an account somewhere. And the question is whether or not the fiat actually,
so
whether or not the cryptocurrency actually is backed.
Yeah. So let me supplement on that. The biggest differentiation of dollars versus stablecoin is actually the counterparty risk.
Sorry, Wilfred. Go ahead.
Yeah, sorry. I was going to supplement that on your point. The biggest difference between the stablecoin in general and the US dollars is obviously the counterparty risk associated with the issuer. Now, if you have a somewhat more opaque as Tether, the counterparty risk is unknowable. But if you have someone like a USDC, which is we know where they are. There's audit properly audited by Grant Thornton, as an agent. So we can see the attestation report and so on and so forth. So the counterparty risk will become more transparent and knowable. So although there is a counterparty risk assignment to USDC, the Circle USD, it's knowable, right? So it trades on a premium basis. So you can see, like in the way I look at it is more of a USDC as a substitute for Tether over time. And obviously the market for it grow significantly as well over the last year and a half.
Yeah, and so to the extent that the answer to this question might be perceived as negative, I don't think we're negative on stable coins. I just think that this particular one, it doesn't pass muster to be something that institutions are likely to be able to transact in. But there are others that I think, and more to come probably, that will be. I think we'd be remiss if we didn't at least give some people some kind of directional comment about what we think is going to happen in the crypto market over the next year, and whether we think the crypto is going to run hotter, higher based on the demand we see in the market, or if we think there's going to be a cooling off period. And I know that you guys aren't necessarily prognosticators professionally, but it's hard to have one of these and not try to answer this question as to whether or not we think there's more demand for digital assets by the end of this year than at the beginning.
Yeah, Dominic, I can answer that in terms of the type, some educated guesses around the types and the evolution. We've started to see some larger institutions enter into the space. I think that's going to continue. Back a year or two ago, conversations were usually, hey, let's provide some general education. Can you please tell me how a blockchain works? Okay, great. I'm going to now present this up to my management committee, and now and that'll kind of end the conversation. Those conversations have shifted dramatically, and they're now, okay, can we get moving with opening an account? So I think we're going to see institutional adoption continue to rise substantially. I think we'll see volumes on CME continue to rise. CME is launching an Ethereum product. That's going to help the institutionalization of Ethereum as an investable asset with institutions. And I'm going to have to take a little bit of a bullish stance on potential, positive regulation in the U.S. So I think there's a lot. I think 2021 is poised to kind of pick up where 2020 left off, where we saw a 50-60% rise in the price of Bitcoin. I don't like to give price predictions, but in terms of overall adoption, market maturation, I think we're just going to continue seeing trajectory in terms of.
Yeah, Wilford.
Yeah, great. Yeah, thank you for that comment. We also see more institutional adoption in the cryptocurrencies ecosystem, and specifically, we do a lot of work in the crypto derivatives world. So we're seeing volatility currently, implied volatility from the options market, roughly about 20-40% in crypto or in BTC, and close to 200% in Ethereum. So in the short sort of intermediate run, we expect the volatility to come down significantly. So normal and sort of normalize around roughly 75-70% volatility range for Bitcoin, and roughly about 100-ish for Ethereum. We're also seeing significant interest in the ETP space. That's growing significantly, and to a certain degree is sort of a track the sort of the Go ETF type of path, and that's quite interesting. We're also seeing growing institutional interest in structured products. For instance, auto callables, and a few other bespoke products out there. We're also seeing interesting conversation at this point for volatility, trading opportunities in the crypto ecosystem. So I think what I'm trying to say is that as more hedging or risk management products exist in BTC or in crypto space, the more institutions are coming. So the cycle actually is very, very, very interesting. It's helpful to create that network effect to bring in more institutional adoption into the ecosystem as the risk management strategy or risk management and the market sort of market structure completes itself over time. So I think I don't give price predictions, but I do see the volatility come down over time. Let's call that 6 months period of time, given where we see in options.
Sven, do you have a sense of crypto demand higher at year end than now or lower?
So, well, obviously, I wouldn't know. But we believe in the story of digital assets, and crypto forms part of it. You also have regulated financial instruments that then just happen to use blockchain. And in a way, I think what's now happening in ETP, maybe the first example of this is this area where basically traditional capital markets and crypto come together somewhat. And I think that's an area that I do believe has potential to grow quite a bit.
I actually had a question come in just a second ago that I want to get you guys to answer. We're right up against time, but I think it's necessary. It's one related to the leverage we see in the market. About the amount of leverage being used in the BTC and altcoin markets. Do you see this as an issue at this time? Have you seen cycles that might correlate with BTC price? So does the leverage cycle play a role in the BTC price rise? And are you concerned about the amount of leverage in the market in general?
Yeah, so let me take a step on that. So leverage means different things, right? So in the sort of a classical, crypto, microstructure sense, it's more leverage in the unregulated markets. Like BitMEX of the world, there's an opportunity for people to play 100 times X leverage, and so that type of unregulated market, I won't say died down, but it will be overtaken by regulated markets like CME. So CME is leverage is there's some leverage, but it's not obviously not 100 times. So there's some leverage from trading perspective. Now, the second form of leverage we see in the market is actually the lending business, or loan business. That really. If you look at the Genesis intake in terms of origination, loan origination, and there is a sense of leverage that will impact where the market price is, impact price. However, the loan market in general relatively small compared to the overall market cap of BTC or crypto market. So it's very hard to quantify the leverage due to the pricing itself. But the leverage is something that the leverage level in the crypto ecosystem is something that we should be watching on daily basis, and we do, right? So I don't know if that answered the question, but that's my 2 cents there.
Is there a sense that we have entered the stupid level? Have we approached the stupid level of leverage yet in this market?
No, I mean, I think fairly large, like mature institutions like Genesis, and they are very cautious about extending credit, or they are building up their risk management team. They've been very sophisticated themselves. So I do see sort of measured job in terms of providing leverage in the ecosystem at this point. But however, in regular markets, I cannot tell. There are always retail clients trading 100x type of products out there, and from institutional perspective, there's controlled, I guess, or measured, leverage play in the space. If it's a I don't think we're reaching a crazy space. It's more of a pin-up demand, for folks coming in from traditional or new crypto adoption or institutional folks out there and buying up the dips, if you will. So to answer your question, I don't think we're at a crazy leverage level. This is that's why the press action is actually quite interesting to me. I feel like there's real support levels in the market coming out of the institutionals.
Anyone else have a view on leverage in this market? No? Okay. My sense is that it's fairly early. I think there's still some days where you can't. There are days when we can't make a loan. Like we lend crypto, and I don't necessarily have people knocking down my door to get it. There's places I know where I can make loans, so there is demand. but I don't actually see the demand as ridiculously high. I'm waiting for more borrowers. I'm waiting for the number of borrowers to multiply. I don't know, maybe even like 5 or 10 fold before I feel like, okay, this thing's about to get really stupid. Which doesn't mean that there aren't bad loans out there, but I think by and large, there's not. It's not that crazy, not yet. But it is something to watch, and I think in the future, a bubble may be coming. We're just not there yet. And another question about price. Is it worth remembering that the halvening on May 11th last year is likely to contribute to a bullish cycle through the summer, this summer 2021, if history is our guide? Anyone have a feeling about?
If you subscribe to the fundamental valuation model of stock to flow, which basically tries to replicate the number of days to replace the existing stock available in an asset, like the traditional weighted value gold, Bitcoin's supply halvening. So to level set with everyone, new Bitcoin is created on a set schedule, and every 10 or so minutes, new Bitcoin is entered into the system, effectively gamified using a zero-sum algorithmic tool called Bitcoin mining, and miners are rewarded for their inputs in order to basically find the new Bitcoin. And that new Bitcoin enters the system, it's directly injected into the system essentially by going into the hands of miners who are operating these machines. And so the reward was cut in half. The mining reward on its set schedule gets cut in half every 4 years. It was cut in half last year, meaning instead of 1,800 new Bitcoin being inserted into the system every single day, only 900 new Bitcoin are being created. And out of those 900 new Bitcoin being created on a daily basis, it's really interesting because if you look at the subscriptions into products like Grayscale that hold a leveraged position of Bitcoin against the balances of the fund, and look at things like Square's Cash App, there may be more than $900 million flowing out of the Bitcoin economy and into wallets, basically being stored offline every single day. So it's really interesting to watch this happen. Usually within a year after this event takes place, where the new supply issuance is cut in half, we do see prices rise. And I think Citi, Guggenheim, Morgan Stanley, and others have put out research kind of making generalized price predictions in terms of what this means. And they range pretty dramatically, but there's support in the traditional investment community around Bitcoin at a six-figure level, kind of based on this decrease in supply. So definitely something to keep an eye on. I'm not sure if it's completely indicative based on where things are at right now, but definitely one of the better metrics we've seen in terms of being able to value Bitcoin over time. So stock to flow is something interesting. And
maybe as we close, we could talk about, so we have a significant number of wallets that simply hold Bitcoin, and that has been true really from the beginning. So as all this new money comes into the market, where are they sourcing Bitcoin from? It seems you have a significant amount that really doesn't flow at all. It just sort of sits. So, how much of Bitcoin really is there available for all of this institutional money that we've been talking about coming into the market? And what does that do to what impact does that have on price? The number of people who are, as they say, hodling it or holding it or hoarding it, depending on how you view it. So you have this very limited supply of Bitcoin that's available to be purchased. And presumably, as you said, something like there's a tremendous number of corporates that hold it on their balance sheets, in addition to institutional funds who've been coming into the market. So how much is available to purchase? Is there a Bitcoin shortage? Anyone?
If there's a Bitcoin investor who's better suited to answering this question than I am, so I will do the favor of pointing everyone to his investment research to read kind of more yourselves. But the investors, the firm's name is Ikigai Asset Management. The investor's Travis Lang. And in his December 2020 newsletter, which is available on their website, Kana and Katana, they talk about the supply side liquidity crisis, where they go through all the different things that are eating up Bitcoin supply. The availability of Bitcoin is usually generated through, order book volumes on exchange or market makers, and those volumes there's still plenty of liquidity available on a daily basis. There does seem to be supply being eaten up rather quickly. I would certainly recommend Travis's piece for anyone who lays out kind of 7 or 8 different venues or the 7 or different conditions that are kind of playing a role in this diminished supply. I'll link it in the chat.
Yeah, please do drop it in the chat. And Zoe from our team actually just dropped a bunch of other links to research in the chat as well. Some from Fidelity, which publishes quite often. They have a digital assets blog in addition to some research pieces. Napoleon Asset Management has done an academic piece on holding Bitcoin as part of your portfolio. So we've linked a bunch of these things in the chat so that you guys can grab them and read them at your leisure. I know that we've kind of tossed a lot at you here. I'm interested in hearing your feedback because we've discussed with Mark creating a series around crypto, and really with each session hitting on a different set of topics that kind of meet the needs and interests of the group. So we'd love to hear your feedback on this session and see if it met some needs and find out what the other needs are, such that we can put together more panels or different types of talks to sort of continue to inform the group about what's happening in crypto. The one thing for people who are not crypto native that I find is sometimes the conversation gets stuck in a place and really a time where they have a very valid criticism. And so they put it down and leave it without realizing that the ecosystem has evolved and continues to evolve. Crypto moves really, really quickly, and a lot of the issues that have existed in the market have solutions that have come about, and especially in the last 2 years. I think the last 2 or 3 years have been great certainly for institutional investors to be able to come into this space. And so I find that people who've put crypto down and decided to leave it alone are not aware frequently of the new stuff going on that makes this more palatable for institutional investors. And so that's an area where I think we can help close that gap. So, if there's anything, a question, concern, or some feedback on this talk, something that you want to see addressed, I suspect there may be some information we can help you get, or some people we can bring that will speak to it, such that some concern you had in 2016 has now been, at least some of the concerns have been mitigated, if not all.
It's a good point, Dominic. I waded into the cannabis world about 4 or 5 years ago, and I was extremely underwhelmed by the professionalism and all the rest, but it has quickly accelerated. And maybe I'm glad I didn't go in hard either way. I have been on the fence, admittedly, on crypto, but you need an entourage, a village, a community to help with the vetting, and so this is part of a process. Some people are way out ahead of me, like you. But I think it's good for our community to have the deep dive 4, 5, 6, 7 as we're doing in so many other areas, and welcome everyone's thoughts. I'll just put on, if you come on Tuesdays and Wednesdays at 10:30, I think this sort of this particular event probably started somewhere in October, November, with Dominic saying I could do that, I could do this. And I said, we'll do it. And we did it. So we can, and Joe Zaro also had a great fireside chat with Andrew Chen and Marcos Varimas with their perspective. And so if we put our heads together, I know Nisa wants to, weigh in, and Mitchell, his one word. What was your one word for our 2021, Mitchell? Was Bitcoin or crypto? Crypto.
I think it was go crypto.
Go crypto. 2 words. That's right. And Dan Wolf, you're sitting in Moscow. We've been talking about this for a while. So you're, a lot of interesting players. Actually, when I think of these kind of things, I think about Russia, where he's sitting, and there's sort of you want to pick your spots and be smart. And so it'd be interesting to see how we put our heads together and what we can do together. Bill Deukler, you know the space from your Morgan Creek days. So just, if anyone's got any ideas, Tuesdays, Wednesdays are particularly good times, but anytime, let us know.
Yeah, and I'd just like to say thanks to Josh and Sven and Wilfred for being able to do this and participating. I think you guys bring a perspective each that's unique, and your firms are doing, big things in our space, and I think it's meaningful that you're able to come and share. It's unfortunate we didn't have Damian here from Napoleon Asset Management. Yeah, we send him a well wishes and hope he gets well soon. I'd love to share that perspective of active management in crypto. I think people may not be as aware of what's going on in that space. Right? There's a lot of focus on the Grayscale Trust for Bitcoin and Ethereum, and there's been a lot of talk around ETP. People may be less familiar with actively managed strategies in this space. So I'd love to maybe, if there's interest, bring him on, and some other active managers who can talk through some of the strategies that they're executing on, the kind of risk return profile one should expect in that space, to sort of bring in that other perspective as well.
Dominic, one other thought is what we're finding is another way to do this is you can go from these deep dives to a summit, which is a longer session. And I would just encourage, it's always fun to have, like in the water event, that people that actually disagree with each other. Bring on a skeptic or two, and let's have at it.
Are you
Absolutely.
going to invite Rubini to the conversation?
What's that, Wilfred?
Nouriel Rabini, he is a regular, or used to be a regular at crypto conferences as the skeptic. They would bring him in and do debates with members of the crypto community. So he's a well-known skeptic, and has gone to many places to talk about.
He sounds like a skeptic you like that you could beat up on or something. I don't know. I want to let's get some fresh skeptics, but that's fine.
No, fresh skeptics are good. I've actually done one-on-ones with members of this group who are skeptics. I was a little hopeful that they would chime in, but we really didn't hear from them today. But there are definitely people here who are skeptics. So maybe they were a little shy today, or maybe they were a little busy. But I think we can definitely do something where we can bring the other side in and have a spirited debate.
Sounds good. Any parting thoughts or questions or comments?
I actually did not answer the question related to where I think digital assets are going this year. I'm rarely bullish on anything. I'm actually pretty bullish, with the caveat that this space has always been volatile. For people who are not accustomed to crypto volatility, you will be on a wild ride. I can almost certainly tell you that. Now, we do have some new money come into the market, and maybe that money is more buy and hold, but this has been a pretty wild space. Bitcoin fell in half on either March 11th or March 12th. I can't remember which day, but I was actually running a panel much like this one while it was in free fall, and people in the audience were watching it go into free fall. So that does happen. But it's hard to believe this, with all this institutional focus and all the products that are going to be made available, and as Wilfred mentioned, all the risk management products that are going to be made available. It's hard to believe that we don't have substantially more demand for crypto at the end of this year than we did at the beginning. And I know that's saying something because we've already had a nice run, but just behind the scenes conversations we have with people, large organizations that have been chomping at the bit to do this for a while. People have finally gotten board approval to do this, in part maybe because custody was not appropriate at the time, but now it is, or for some other reason. So it just seems that there's still money sitting on the sidelines that wants to be in this space. So I'm pretty bullish on digital assets in general because of that. And just be prepared for volatility.
Fair enough. Anyone else? All right, then. Well, thank you, everybody, all the speakers. Thank you, in particular, Dominic, and putting this together.